Hello. Welcome.
Hey,
Hey, hi, Brian.
how's it going?
Good. Welcome, everybody, to our webinar today, which is called Scaling Your Real Estate Portfolio. So, first, I want to welcome you to LeAnn Riley's Real Estate Investing Club. I'm LeAnn, and I help busy people build real estate investing income without being stuck or fearful by mastering the proven step-by-step system to get cash flow deals. And the truth is, you don't need a ton of money or knowledge to get started as a real estate investor. You just need to know the right formulas and follow a system to be a smart investor. And today we're going to talk to someone who has his own system. We're going to ask him questions about that. We're broadcasting live on the second Wednesday of every month at 7 with guest speakers like Brian. And they're always experts who are active in real estate investing. And the thing is, you can participate from anywhere and you can be in your jammies. So we love that. I'm also a real estate expert that helps clients buy, sell, and invest here in the Twin Cities, Minneapolis, Minnesota market. And why me? Well, I just give you my brief story. I built a multi-million-dollar portfolio of properties, including residential, multifamily, some condo development, some commercial, and even vacation properties, because I love to travel. South Carolina, one of my favorites. And I'm also a national coach, and I teach my proven profit formula to people around the US. And I help you get started. That's the biggest deal for real estate investors. What strategy, where, and how do I get going? So I'm so glad you're here with us tonight. So let's get started. And I'm first going to give you a little intro on Brian, and then we're going to find out the real goods here throughout our webinar. So Brian Doyle here, he's a multifamily investor, and he's the owner and manager of over 65 units, mostly condos. And he also has syndicated ownership interest in about 500 units. He's the owner of the Doyle Property Group. And here's what's cool about Brian. He also has a full-time day job selling window blinds to the apartment industry. And he likes his day job. So we're going to find out about that. And one more thing I want to tell you, how do I know Brian? Well, this is why you got to network, folks. I was at a multifamily summit maybe 6 months ago, and I ran into Brian and I got to talking to him, and I could see that he was a successful investor. Love meeting them. And so now we want to find out his secrets. And I want to find out, how does he handle that large portfolio and still have this day job and love his day job? But he's making money over there on that portfolio. So he's a man living a life he loves. And that's what this is about. Don't let the real estate take you down. It's all about the passive income. And then we can do what we love. So let's find out how he does it. So Brian, I want to start out with some questions for you.
Love it. I didn't know you like to go to South Carolina, first of all. I was just looking at some deals down there. They're really good condo deals down there. They're really inexpensive, about $50,000 to $100,000. You can buy a nice condo in, I think it's Myrtle Beach area.
And, I invested in Edisto, South Carolina. It's about an hour south of Charleston.
Okay.
It's like Gilligan's Island out there.
Awesome.
No stoplights.
Oh,
Way back in the low country, as they call it down there.
I love it.
Loved it. Okay, so how did you decide to start investing in real estate?
Well, good question. I mean, if you want to go way back, I really learned that I want to be an entrepreneur when I was in Cub Scouts. It's sort of a long story, but basically the bottom line is they said whoever sells the most popcorn will win a bicycle. And I told everybody I met, I said, man, I'm going to win that bicycle. And And everybody said, no, dude, there's a lot of kids in Colorado. This was Colorado Springs, a lot of kids in Colorado Springs. Don't set your sights high. I mean, leaders are telling me this, other kids are telling me this. And I just said, I'm going to do it. And for 3 weeks in a row, I went out after school and I sold popcorn door to door, and I won the bike. And I realized that at that moment, right, I realized that, if you just do everybody with almost 99% of people out there are just, they just don't believe that they can do it. Right. So you really don't even need to work hard, harder than anybody else. You just need to work a little bit harder because everybody else is sitting over there saying they're not going to get it done. Right. So how did that turn into real estate? I knew I always wanted to be my own entrepreneur. I knew, so I had little businesses growing up, and then in college, I bought a house and rented it to my friends. I did it with an FHA mortgage. I went to the bank and I said, I need a loan. And they said, we need a co-signer, because I didn't have a job at the time. So I called my parents and I said, hey, I'd like to do this. And they said, we're open to it, but we want to see it first. So they came up and looked at it. And, I think there was bunch of lessons learned, in that first deal. And I think the biggest lesson is you just got to get up. You just got to do it. I mean, you got to do it. I meet so many people. I know you meet so many people, LeAnn, and so many people, they want to get into it, but they are living paycheck to paycheck, or they have a family, or insert about 1,000 excuses here, right? And the problem is that if you're living paycheck to paycheck, you've got to get on a written budget. If you're not on a written budget, then you don't have any extra money to invest, I mean, that's like number one, and people minimize that thing. So I had about $3,000, and I bought a house, FHA, and moved my friends in, and I lived for free. So we can talk more about that deal if you want, but that's how I got into it.
And that was up in Duluth, right?
Correct. Yeah, I was going to college at University of Minnesota, Duluth.
And that's when you first became a property manager, right? Because you had to manage those roommates. Yeah,
absolutely. And the other thing I really learned, I mean, there's 1,000 little things I learned from that first experience, one of them is people's incomes. Okay. Most people spend about 25 to 30%, or 35% even on their housing expense. Okay. If you can get rid of that housing expense by buying a property and moving into it and renting it to your friends, or buying a fourplex and living in one out of the 4 units or whatever, if you can get rid of that housing expense, you've just opened up 1/3 of your income in order to invest in real estate. So I really think like you almost have to be laser focused on it. I think every decision you make has to be tied around that goal. If you want to accomplish that goal, you got to go out every day and go sell the popcorn, or you got to do it every day and do whatever, but you got to be laser focused.
I love that about your bike story, because you decided that at whatever age you won that bike, that it didn't matter if you had to knock on those doors, you were doing whatever. And the other part I love is, when I believe in manifesting, and you told those people when they opened the door, I'm going to win this bike. They probably gave you more money.
I should have. I probably should have. That would have been a way better strategy.
That is a great strategy in real estate investing. You got to wake up in the morning, just like you said, and tell yourself, I'm going to find a great deal.
Oh, totally. I totally agree. Gerald Ford, I think, said it. If you believe you can or believe you can't, either way, you're right. I mean, it's so true. So a little side note from that, just since we're just having fun chatting. I for the first 40 years of my life, I've always read real estate book after real estate book, or business book after business book. Finally, I'm 42 now. I decided to start reading happiness books. I'm like, I might as well learn something about being happy, right? Like, why not, right? And one of the things that they say with happiness is you've got to scan the environment for happiness, right? if you scan the environment for negativity, you're going to find it. If you scan the environment for positivity, you're going to find it. And exactly what you're saying is that just go out there and focus on what you need to focus on, because you'll get there. So I love that. I love that.
I like what you said too. You said, I haven't heard a lot of people say it the way you did, and I think it really hits home. If you can cut your living expenses, that 25 to 30%, that's a lot of money in the pie. And
Tons of money.
that means, and you have to add to that, maybe you can't go to Starbucks. You got to make your own coffee before you go out in the morning. Those kind of things, millionaires live frugally. And we're just smart, about those little things, because we're focused on what we're building.
I totally agree. I think every decision you make after you, I tell you what, it's talking about happiness. I mean, or empowering. It's empowering to have a goal and focus on that goal. You know what I mean? If you kind of haphazardly kind of wander through life, I think we wouldn't be as happy, right? Because you don't have a purpose. And the other thing I've learned, and not that this is a happiness podcast, but real estate is similar, right? You have to have a purpose in life. And if you have a purpose of building a real estate empire, if you want to call it that, or a real estate portfolio, then you've got a purpose and you can keep driving towards that purpose. So
that's right.
Totally love what you're saying.
Yeah. And I'm curious now about your happiness project. I love the part about just no matter where you are, look around and it's there and go to that versus the negativity.
Yep.
Tell me how you are applying the happiness to your real estate.
Well, I mean, happy people in general, and this isn't something I've read, this is probably just something in my opinion, but I think people that are positive and people that are happy live longer. They're happier. They're around happier people. They attract kind of fun people around them, and you become who you hang out with, right? So if you're a negative Nancy or negative Phil or whatever they call it, then you're gonna attract those people to your life. Well, who wants to hang out with that? I don't want to hang out with that person, and I know you don't, right? So with real estate too, it's the same thing. It's like if I'm gonna be positive, then I'm gonna attract people that want to help me, and you and I are gonna get together and we're gonna talk about deals, and you're super awesome. So if you're like, hey, let's go have a cup of coffee, I'm like, well, that sounds awesome, but if somebody's super negative, then you're like, hey, let's have a cup of coffee, you're like, I got other things to do with my life, right?
Yeah.
So I think it all ties together, right? Real estate is just one avenue to build wealth, right? Or it can be a very, very difficult way to build wealth, in my opinion. It can be a very easy way to build wealth. There's pros and cons to real estate. One of the very big negatives to real estate is it's expensive. I mean, you want to buy an apartment building, a 100-unit apartment building, it's like $10 million. Okay, that's a lot of money, right? If you want to buy a condo, it's $100,000. $100,000 is a lot of money you got to raise, right? So real estate can be negative in that way, but I tell you what, it starts to snowball, and we both know this. If it's snowballing, then it's just the greatest thing ever. So
I always say that real estate is the biggest investment we're ever going to make. It's more than your cars. It's the biggest thing, and no wonder most people have fear. Even experienced people like us. I lose sleep the night before or the week before because I'm running the numbers in my head over and over and over. It's just part of it.
No, totally.
And it's a skill, though, is to have enough knowledge. You don't have to know everything to make a risk, take a risk,
I know
but have enough knowledge to know it's the right direction. So you take the leap.
Yeah, no, I definitely agree. And I don't think you have to, at least when I was younger, okay, when I was 20 years old and I bought my first house, I wasn't very analytical, right? I've gotten a little more analytical as I get older, which is almost unfortunate, but I have, right? So now, but back then is like, just do it. That's what all the rich people do. Just do what the rich people do. Or that's what all the successful people do. Do what the successful people do. You know, you don't have to overthink it. I don't think. Just do what they're doing. Like stock market, invest in the stock market. Okay. Is that the right thing to do? I don't know. Right. But that's what everybody does that are successful. So that's what I'm going to do, you know?
Yep. So what investing strategy do you focus on primarily?
Well, so I mean, just to go, I mean, so it's changed over the years a little bit, right?
Okay.
So that first house I bought, and then I was renting it to my friends, and it was fantastic. It worked out really well. Then I bought a couple more houses up there, and I bought a fourplex, all with debt, you know, and then so I bought this fourplex. It's kind of a fun story. I'll tell you it real quick. So
Okay.
I was down and living in Minneapolis, and I was up in Duluth meeting with the housing inspector at one of my properties. And, you know, they're going through, and, you know, he's kind of a grumpy guy, and he's giving me all these things to do, you know. Geez, you know, that's not fun, right? He's telling me, you got to do this and this and this and this. And I said, you know, I said to him, you know, you're kind of a grumpy guy. Do people ever like get annoyed and say, I don't want this property. Do you know anybody looking to buy? And he says, yeah, every once in a while I get that. I mean, of course I was kind of joking around with him, but like, you know, but so he calls me up like 3 months. I give him my business card. Okay. So you need it. Number one, go get a business card. They're like $10 on Vistaprint. Okay. So I gave him my business card, and it said, you know, Brian Doyle, asset manager, you know, Doyle Investments or whatever I think it was called. So he calls me up like 3 months later, and he says, hey, do you ever buy in the cities? And I said, well, I live in the cities. Yeah. What do you got? He says, well, I know this guy that in Duluth, and he's looking to sell his fourplex in the cities in Brooklyn Center. So I said, okay, well, great. I'm going to go check it out. So I drive over there, and I looked at it, and it was awesome. I mean, it was fantastic. It was 100, and at that time it was 2000 maybe, you know. And I looked at it, and it was for sale for, the guy wanted 135,000. Okay, which is great.
What a good deal today.
It was a good deal. I mean, it needed a lot of work. But the guy was a tired landlord. I mean, there's a lot of lessons there too, right? Like there's a lot of hidden lessons. Like the guy was a tired landlord. I was out talking to people. You need to be out talking to people. You need to be out, you know, you need a business card so you can give people your contact information. You know, tons of people don't have business cards, which I think is crazy, you know. That say real estate investor, it might say like something like, you know, your day job or whatever. But anyways, long story short, I ended up buying that from him. And then I spent about every weekend, you know, I still had my full-time job. I spent every weekend fixing it up. Okay. Put new siding on it, put a new roof on it. I did the roof myself. I mean, all sorts of things, right? I mean, it was kind of fun. And then somebody came along in 2005 and said, we'll give you $400,000 for this property. And I said, God, that's a great idea, but I don't know. And okay, so they tell me this. I said, no, thanks. Like a month or two later, there's a bullet hole through the front of the building and through another wall, and it lodged itself into the third wall. And I was like, yeah, I'm good. I'll sell, you know what I mean? So I sell, but then I don't know what to do with the money. Okay. It's like, then I have this big gain. I have this $250,000 gain. I don't know what to do with. So I do a 1031 into a tenant in common building, which is an office building. And that ended up going bankrupt, in 2012. Okay.
So you had it about 5 or 6 years first.
So I had it about 5 or 6 years. But I mean, literally for 2 of those years, almost, I'm getting the dates a little bit mixed up. No, not 2012, 2008. It went almost immediately. And as soon as we bought it in like, let's say 2005, 2007, somebody had come through and said, we're going to move out, you know? And we said, no, you have a contract, you have a lease. Well, they moved out anyways, you know? And then another tenant was like, hey, we're paying $18 a square foot. We can't afford this anymore. We can only afford $12 a square foot. And then they started paying $12 a square foot. And I mean, anyways, after a while, we started writing checks every month just mine was $1,500 every month.
I call that the risks of commercial. You know, a lot of people I work with a lot of people in the multifamily sector, and sometimes people say, I want to go commercial. I did it myself. My biggest college education cost me $350,000. And it's my Harvard education, I call it, but it's going from residential to commercial.
Well, yours was more expensive than mine. Mine was only $250. So,
but
I know exactly.
I totally agree with you, because, you know, people always need a place to live. You can get a new tenant, and that's what I like about multifamily. Only one guy's gone, or two guys, not a long-term tenant or they bargain on the rent. Yeah. So it doesn't always work out, is what I hear you saying. Lots of times it does, like the fourplex, and sometimes it doesn't. What did you do after like that happened? You were devastated.
So I guess your original question was, how am I building my business now, right? So after that happened, I mean, I was just like, I don't want to say I didn't care, but I just knew that was part of the process. Yep. Honestly, I just knew it's part of the process. Robert Kiyosaki says, he's never met a wealthy person that's never lost money.
Yeah.
He's met lots of poor people that have never lost money. You know what I mean? So again, I'm like, okay, cool. You know, I knew that was going to happen. Every deal you hit isn't going to be a home run, right? So like, you know, again, it's looking at positivity versus negativity, you know, on it. So, look at the positive side. I mean, otherwise you can go cry yourself to sleep every night, but I don't know what that's going to do for you, you know? So, so I looked at it as a learning experience. And what did I learn from there that your listeners can also learn is that, number one, you have to buy value add properties.
I love that.
If you're not buying value add, all you're doing is you're buying something and crossing your fingers and hoping that the market improves. Okay. That's all you're doing. You're totally gambling if you're not buying value add. Mm-hmm. Because there's a lot, you talk about commercial, there's a lot of commercial properties out there for sale that are a triple net lease with a Starbucks or something, you know, and it's a 6 cap, meaning if you bought it for cash, you'd get 6% return on your money. But that example and my office building example, it's 100% occupied. You can't increase occupancy. It was a Class A building in Wayzata. You can't improve the location. You can't make it a Class A plus building. It just didn't exist. And then we were getting premium rents. We couldn't bump the rents. So all of those, it puts the building up here at its valuation. Well, you've got nowhere to go but down. Now, if you I also bought a vacant Pizza Hut last year, and you know, it's vacant. It's a vacant building, and
down there.
What's the worst case scenario? It's going to be vacant. You know, you're already in the worst case scenario. It's a dump. You know, I mean, it's ugly. It needed a paint job. Everything was already the worst case scenario. The only possibility was for it to go up. You know, so now I have a tenant in it, and let's say the tenant moves. Well, it goes vacant. Well, that's how I bought it. It's okay. So I think the lessons learned is you gotta buy value add somehow.
I think that's a brilliant lesson, and I like the way you told the story, because I get it.
Yeah. Well, you've been there.
You have value add. Yeah.
Gotta buy value add. So now what am I doing, LeAnn? Now I'm buying condos.
You're buying condos.
I'm buying condos. That's been my strategy since about 2008. I had bought one condo a long time ago in 2002 for like $112,000. That condo in 2008 lost value and became about $45,000. Okay. Well, are you going to look at, again, are you going to be happy? Are you going to look for the positivity or the negativity, right? The negativity is, oh God, I lost another 50,000 or whatever it is.
But that's paper money.
What's that?
You lost it on paper. You still
paper. Yeah, I still had the property because I had bought that cash with a partner. But or is it positivity? The positivity says the neighbor's condo is now worth $45,000.
Uh-huh.
And both neighbors are $45,000. So now I can buy that neighbor, and I can buy this neighbor, and I can buy across the street and across the hall. So it's like, game on. I'm going to put everything I can get my hands onto into real estate, into condos. So that's what I did.
So you bought during the bad times.
Yeah, I mean, and I bought during the good times too. But at this point in time, of the journey, it was 2008, and it was bad times, right? And now everybody else, I told everybody, everybody I could listen to, all my buddies who I sailboat race with, I said, guys, you should buy some condos, man. Buy some houses. Now's the time. And everybody's like, I don't know, what if they go down more? And oh my God, all this stuff again, right? And it's like, and I mean, when you buy a condo for $20,000 or $18,500 is the cheapest condo I ever bought. Okay, it was a 1-bedroom with a 1-car garage, and it was renovated. I didn't even need to renovate it. And I'm like, what's it gonna do? Go down in value? And I went to the bank and I got a cashier's check, and they're like, oh, what kind of car are you buying? They always would ask me. I said, I'm buying a cash producing property. So the story there is you gotta be ready to pounce when you have that ability.
Yeah, you do. You have to have your ducks in a row, which means your finances and your team. So right now you're really a buy and hold guy, and you're managing 65 condos on your own, right?
Well, no, not really on my own. I have a full-time office person that I employ. And then I have not a full-time, but a dedicated maintenance person. So he gets all the maintenance calls, and she gets all the other calls. And, she sets up things with the vendors, and she sets up the showings with the tenants. And
so she's your property manager, more or less. Your full-time office person does your bookkeeping or whatever, and is your property manager.
Correct. Yeah. And I don't have the luxury of doing it myself, because I'm fairly hands-on guy, but I don't have the luxury of doing it myself. I've got a full-time job I got to focus on,
which is great.
A lot of your listeners do too, right? So
absolutely.
We're doing 65 units with just a couple of us, and I really try to stay out of it as much as possible. We use a website called Asana. It's ASANA. It's a great website because you can put in something there. Like if my office person gets a call, she will put it into Asana, and then you'll go down the list, and you'll and then it stays on there until the maintenance person gets it off. So it's just a good system for doing that.
That's your project management system. So that's how you know what has to be done where, and the maintenance guy takes care of it. So what I hear, Brian, is you've built yourself a team of the right people and trained them, and now they're kind of handling all that. And you then can do your day job, and you really don't have to worry about this, and you get the check in the mail.
Yeah, no, it works out pretty well. So, it does work out pretty well.
Okay. And then, but along with those 65 units you have of the condos, you also have invested in some syndications. And just for the people who don't know what that is, do you want to explain?
Yeah, no, definitely. I'd love to explain. And so, a syndication is we'll typically have a general partner and a limited partner side of the thing. So it'll be a company or a person. If I was going to syndicate a deal, I would be the general partner. I would go find the deal, let's say a 100-unit apartment building in South Carolina, and I will find the deal, and I will put the deal together, and I will negotiate the deal. And typically the general partner will sign the loan documents and personally guarantee the loan. So people think it's great to be a general partner, and I think they're probably right, but they're taking on a lot of risk. I mean, if they're personally signing for that $10 million property, then they're taking on a lot of risk. Okay. So to use a $10 million property as an example, then they're going to need to bring on, let's say, 30% of that in equity. or in cash, right? Well, a lot of syndicators, they don't have the 3 million. I mean, a lot of them do, but like a lot of them would prefer to keep their own 3 million and then go find more deals, right? So they say, okay, well, now I need to raise the 3 million. And what they do is they go out and they find other investors that want a piece of the deal. Okay, so typically what they'll do is the investors will bring on, one investor to however many will bring in the 3 million, and then now you'll have the organization that owns this 100 unit. The 100 unit will then, out of its cash flow, pay the first mortgage, whatever that interest rate is. Let's say it's 4.5%, and then they'll pay the loan that the limited partners brought to the deal. Okay, and the limited partners will require a larger percentage rate, typically like 8 or 9%. So then, out of cash flow, you'll pay the first mortgage, then you'll pay the interest on the limited partners deal, and then the rest of it is either invested or saved for the property's future things, or is distributed to the partners on usually a 50-50 basis after that. So, and then at the time of sale, let's say it's sold for $11 million, just to pick a number. The 10 million, or excuse me, 7 million will go to the bank to pay off the first mortgage. The 3 million will go back to the investors to pay off their loan to the property. And then the what's ever left will get split 50-50 between the general partner and the limited partners. So that's how a lot of them work. It can be good, and it's got pros and cons as well.
I think, on something like that, as I would say with anybody I've ever advised around real estate, you better know who your partners are.
Oh, that's number one.
That's the critical number one. Yeah.
Totally agree. The partnership is all that matters. Almost.
Yeah.
Way more than the deal. Yeah.
Yeah. Yeah, and you better trust them, and they better fit the happiness quotient, or.
Yeah, no, I agree. Or the Cub Scout oath, because like honestly, like I've talked to a lot of syndicators before too, and I'm not one of them. I haven't put a deal together. That's not saying I won't in the future, but you've got to partner with people that are hardworking, honest people, because honestly, though, you can make those numbers look anything you want. I can take the pro forma from 100 unit and I can make it look like a really good 10 cap or 10% return on an investment, or I can make it look like a 0% return on investment. It's all about playing with those numbers. You got to find out where the most likely situation is. And that's a great illustration as to why we as investors, we got to understand those numbers, because like you said, they're interpretive. And many times you find a deal on the market and the numbers look a certain way. And if you just believe that, you may not be getting a good deal. You've really got to be able to go, wait a minute, that one doesn't look right. Or have your own way of analyzing. You've got to know that, or you get stuck in bad deals. Well, and I like what you do too, LeAnn, because like if somebody's partnered with you or whatever, then they can go to you and say, hey, I'm looking at this deal. Does this look right? Or something,
Yeah.
And you can say, well, yeah, but they don't have any maintenance expense, or yeah, but how are they handling snowplow removal? I mean, things like that. It's like, you just got to look at them and say, well, wait, does this make sense, right? And if it doesn't make sense, it's it's like, oh, well, no, the owner's doing snowplow removal on their own. It's like, okay, well, I as an investor have to put that in as an expense, because either I'm not going to do it or I am going to do it, but I got to get paid for it, because I got to.
I like to always. I'm a bit of a conservative analyzer, because I always want to make sure it's a good deal, and I do want to pay myself though. If I just scale, if maybe I'm a rehabber or something, and don't charge for my labor, well, then really the numbers aren't true. You got to have something in there. Maybe you can pay yourself a little less, but you need it in there.
I totally agree. Yeah. And I work for free a lot, right? But like, but you've got to, when you're analyzing the deal, you have to compare it to another deal. So
Yeah.
if you got two deals in front of you and one of them has a snowplowing expense and the other one has the owner doing it, you may or may not do it yourself, but you've got to compare apples to apples on those
Absolutely.
deals. Oh, yeah.
So what was your biggest mistake and how did you resolve it?
Oh, good question. My biggest mistake. The easy answer is I shouldn't have done the deal at that office building. I shouldn't have 1031'd into that office building. We already talked about the lessons learned on that. But I guess my second biggest mistake is I didn't go deep enough. I didn't go big enough when the downturn was going on. You know what I mean? I bought everything cash, right? And I mean that's great, but you just don't. You grow slow when you're buying cash, right?
So,
and I knew.
Had you have leveraged in the downturn, that would have made a difference, is what you're saying.
Leveraged, or if I would have smiled and dialed and talked to a bunch of wealthy people that are looking for a good opportunity. I mean, I told all my friends, hey guys, this is what you need to be doing. This is what we should be doing. But they have day jobs. It's not their deal, right? So I always say the biggest thing I should have done is I should have bought every house I could have gotten my hands on.
Yeah.
Well, it's easy to say now, but I was going to Las Vegas back then. I was going to Las Vegas once a month for work, and properties down there were just
really cheap.
We're here, you know what I mean? And it's that you just know that when property, anything goes down in value, okay, it's easier to, in my opinion, it's easier to predict where it's going to go back to because you have that past history, okay? So let's say properties are, $100,000 condo goes down to 50, okay? Well, you still have this $100,000 benchmark, right? So you can go back up. It's going to get to 100,000 eventually. The problem is when they go past this 100,000 and now they're at 150,000 or whatever. How do you know where it's going to go? Because there's no benchmark. There's no past performance. So I think if and when we hit another downturn, I think your listeners have a really good opportunity, because if prices go down, that they're eventually going to go back to that benchmark.
Well, my favorite thing about rental property is I don't care if that condo is at 100 today or 50 today, you're still getting $1,000 rent. No matter which number the value is at, as long as it's rented out, you're getting your $1,000, and you can wait till it gets back up if you're thinking of selling, because it's cash flowing.
Yeah, I mean, there's a theory that there's a theory that rents are based off of value. You know what I mean? So we've had sort of a good run in rents, and the fact that, but let's say your rents go down a little bit, so what? You know what I mean? I don't know.
They don't go down that fast. It's more of a gradual down if it is going down.
Yeah, no, I think typically in that instance, what happened? Well, I mean, we can talk about what did happen, right? So what happened there is that the value for that one condo went from 112 to 45. Well, the rents didn't go down at all. Right. So that's a perfect example. That actually did not cause any rents to go down. So.
Yeah. So, what do you do? Because you're a busy guy. You're running that, and I'm sure they call you. I mean, it's not autopilot, right? And it's pretty autopilot.
Yeah.
But at the same time, you might be looking for new acquisitions, and it's still, like you said, it's on your mind. Yeah. So what do you do to stay on top of the game? And maybe this applies to your regular job. What do you do?
Well, I love that question because I think it's an important one. Okay. So when you have a job, okay, so if one of your listeners has a job, right, and they want to own real estate and have a job, I think it's important. I mean, you got to decide. Stephen Covey says you got to start with the end in mind. Okay. Let's say you want to, you got to decide what you want. if you want to own one rental and have something kind of fun to do and have it as a hobby, and there's nothing wrong with that. Maybe you're retired and you just kind of want to have a rental, and it's totally fine. Then just do that, right? But let's say you want to grow your portfolio to 300 units, okay, or whatever. Just pick a number. So let's say you want to go 300 units. You've really got to take steps today as to how are you going to get there. And one of the things you might want to analyze and might want to look at is are you in the right full-time job to acquire real estate and have a full-time job? Now, what I mean by that is there are a lot of different jobs out there, right? I mean, a job is a broad term. You could be a manufacturing person where you are in a plant from 8 to 5 every day, and you're putting the widgets on the line, okay? Now, that type of job is going to not be very conducive to taking a phone call while you're driving down the road to analyze a real estate deal. Or you're maybe, like I'm in sales, right? So I'm out and about all day, every day. Now, I'm also out and about every day talking to apartment building owners, okay? So maybe what you want to do, and that's how I got into my first syndication, but maybe what you want to do is you want to look at your job and say, okay, I want to grow to 300 units, but my job is in an unrelated field, okay? Maybe what you want to do is get a job as a vendor for the apartment industry. There's a friend of mine who owns a roofing company, and he's got like a ton of units, okay? And what he'd go and he'd look at a roof and he'd put a roof on, and if somebody's like, I hate this building, he'd be like, well, let me buy it from you. You know what I mean? So you would do that stuff, right? So I think number one, you got to decide, what are the lessons learned? Number one, you got to decide, what do I want my goal to be? Number two is, do I have the right job to accomplish that goal? Okay. Number three is, do those jobs complement each other, right? So like the fact that I own real estate helps me in my apartment blind selling business, because I know all the people that buy apartment blinds, okay? And I can say, hey, listen, I put this blind into my units, and this is the reason I put my blind into this unit. You can relate. You talk on a totally different level. You totally relate, right? So there's that, and then you got a time block. You've got a time block. People waste money on God knows everything, right? I mean, everything. People waste money on everything. It kills me to watch that, right? But they do it, and then they say they have no money, and they're driving around a brand new car that's leased or something, right? So it's like, dude, you got to do what you got to do to get this done, right? And people also waste time. They waste time and waste time and waste time. I am so guilty of it too. I click on on something, and then the next minute, an hour later, I'm like still doing that thing and I've accomplished nothing. I hate that, right? You got to focus your time and your money where you want it to go. And time blocking is a great way to do that.
It is. I love that. And I time block, or I wouldn't have time to have my personal life if I didn't time block.
I know, exactly.
Any realtor would say that, because we're in sales too. And you have to be in control of your time. Yeah.
Oh, totally agree.
I really like your advice though. If you want to get in real estate, get in some related industry. It can really make a difference. Recently, my son, he was a cable guy, installing cable.
Yeah.
And for years I told him, you got to get over to the trades, get over to the contracting side. It pays more and you'll learn more. And actually he was living in my basement, guys. And you guys might have teenagers. Well, he's not a teenager anymore. And I was like, how am I going to get him out of my basement? Well, I'm going to have to help him buy a house, right? But I'm going to have to, and the first thing was I had to get him, he had to get himself a better job.
Yeah.
So I was steering, and he did. He got a job working for a property manager doing maintenance.
Oh, no way. Oh, that's super cool.
Somebody I knew, of course. And then on top of that, what's really great is now he closed on a house, but guess what? It needs a pretty big rehab. It had some mold. But
Perfect.
now he has the skills, he can figure that out. So quite a bit happened just by changing that job. And he's
I love it.
24. He's a 24-year-old.
Wow.
So I'm excited because he's doing the rehab. The mold got taken care of yesterday. He'll be out of here within a month. I'm happy.
I love it. I love it. Yeah, no, I think, but you're right? Like all those little decisions matter, right?
They do. And it took a long time as a parent to like get that through his head.
Yeah.
But all the little decisions added up. Exactly.
They do. They really, really do. And
so I like that. Get in the real estate trade somehow and connect it. And your job, that's how your day job works so well. It's connected. And as you said, sales is independent, much like being a realtor. We're in control of our own time,
Oh, yeah. No, absolutely.
It's up to us.
And I'll tell you another thing regarding the job thing. I mean, two things real quick. I mean, number one, that's why I got this job. Okay. Because before I was in an unrelated field. And when I was in real estate and I was in an unrelated field, I got laid off from that job. And I was like, well, when I went to look back for a new job, the specific reason I picked this job is because I wanted to talk to apartment building owners, So, I mean, it wasn't haphazardly or by luck. It was an intentional act. The other thing I think if you're advising people, on how to manage a day job and the rentals is you have to be the best blank that ever lived, and let's say you got to be the best blind salesman ever. You got to be the best podcaster. You got to be the best cable installer. Whatever you are, I don't care what you are. You got to be the best that ever lived. And it's not hard to be the best. Remember, that's what we learned in the Cub Scout thing, or I learned in the Cub Scout thing. It's like you just do a little bit more than everybody expects or everybody else is going to do. So if they expect you to get there at 8 and you leave at 5, get there at 7:45 and leave at 5:15. I mean, we're not talking about something radical here. Just do a little bit more than everybody expects, and you will have more work freedom and customers and happy tenants than you'll ever expect in your life. So
I like that. I like that a lot. How do you decide which properties are good candidates? I heard the one thing you said, it has to be a value add. Has to be.
Has to be.
Is there anything else you might like that would make it
I think it has to be in an area you feel comfortable working in. The first house my friend and I ever bought was this little house in North Minneapolis, and we were fixing it up, and I don't know, all the neighbors came over and they're like, dude, you got to be out of here by sundown. We're like, oh, that's funny. And the guy's like, no, dude, I'm serious. You got to be out of here by sundown. You know what I mean? I mean, he's like, that you don't want to be around here. And there was some truth to that. I mean, clearly it wasn't, but I mean, it was just like, or my fourplex in Brooklyn Center, they got a bullet hole in it. Like, do you really want to work in that area? No, you don't, right? I want a place that I feel comfortable going, right? Now, for Brooklyn Center, I think is better than it was, so I'm not against those areas. I mean, maybe even North Minneapolis, those are just my experiences there, right? So I think you need to be comfortable where you're going. I think you need to be in an area that isn't the worst part of the area or the cities or your area, and isn't the best either. I mean, typically everybody wants to own a piece of property on the pier at Santa Monica, or the beach at Santa Monica, right? So like if you surveyed 100 real estate investors, 100 of them would say, yes, I would like that area, or 99% of them would. Now, so then what happens is, okay, they say, okay, well, here's this property for auction, who wants to bid on it? And 99 people bid on it out of 100, so then the price keeps going up and up and up, and the return keeps going down and down and down, right? It might go negative because people are expecting the value to come up. Now, who wants to own a property in some tiny town in in Oklahoma. Well, if you ask 100 people, maybe 2 of them want to do it. So then the value is way down. Now your returns are going to be higher because you're just not competing against those people, right? So I think you need to do it. You figure out where you want it, and then work there. Find a value add deal, and then just find a solid deal. I mean, I like college towns. A lot of people are saying that they don't know how to find a deal right now. Okay, well, one of my ideas might be to go and pick up the phone, or pick up the paper, or pick up whatever you pick up these days, and or Zillow, and go to a town that has that's a college town, and find and call the ads that are in there. I've got 2 ads in the Zillow right now for Duluth, and if somebody called me up and said, or called Debbie up and said, "Hey, I'm not a renter, but I'm an investor. I'd like to make you an offer on your property," I'd say, yeah, we'll entertain that, and I think a lot of other people would too. And there's a lot of advantages there, right? Because then you're in a college town, you always have potential renters, it's kind of younger vibe. If you have to put somebody, if you have to sue somebody for rent they owe, if they're 25, chances are they're going to want to buy a house, and it's going to have to get taken off. If they're 70, and you put a judgment against them, you might just never see that again. So I think college towns are kind of a cool thing too.
Yeah, I don't know if the listeners, the thing about student rentals, you can rent them per room too, and you can get a lot more than market rent for a 4-bedroom house or whatever, And to your point of, there's always a good deal out there. You just have to know the right people.
Yeah.
So I recently ran into a guy, did a strategy session. He said he would like student rentals, and sure enough, I knew of an off-market one, and we got it under contract now. And it's
awesome.
It's a good deal.
Yeah, that's awesome.
That was just, okay, what do you need? Okay, oh gee, I know of one of those. So it's a lot of it is matching people up, but I like what you said about location too. It's not, everybody has a different flavor on location as to whether it's good or bad. It depends on what your criteria is. And, neighborhoods change too. And I have made the mistake of buying in the wrong locations in my past. And you can really tell. I once followed a guru, wrote a book. I went to Birmingham, Alabama. And I loved the theory, economics of why I went there. They were opening a Hyundai factory, so there was 8,000 new jobs.
Oh, wow, okay.
So that was the theory, go buy there. He took us out on tour, showed us a bunch of houses, we could buy those. But being experienced like I was, I thought I knew something. This was dumb, you guys. And I bought on the outskirts of where he told us to. And I bought a 4-plex and 2 single families that weekend. And what happened?
Weekend, awesome.
Yeah, all in my little weekend tour.
I love it.
And a couple things happened. One house was great for many, many years. One house I resold when I got back home to Minnesota, made some money right away.
I like it.
And the 4-plex, though, needed some work. And this is where I was missing a component. I didn't have a team down there.
Yep.
I had a realtor who said she'd help me, and the work took way too long. And I finally had to send 2 guys from here down there for 2 weeks to get it done.
Oh my gosh.
So it took forever.
Yeah.
I wasn't quite ready for that out of town investing. And one house held it for 5 years. Everything was great. Tenant moved, and then the troubles began, you guys. And somebody put a Maltese cocktail, I think they call it. Somebody like bombed the place, something happened. So those outskirts location, had I have probably stayed where the guy told me to, I'd have been fine, but I went on the edge. So what I learned is listen to the gurus. When they tell you what they tell you, there's experience behind that.
Yeah, that's funny. Yeah, I mean, not funny. But yeah, I mean, yeah, no, I hear you. You got to do it. you gotta be where you're comfortable.
Yeah, you do. So, is there anything you would do different now that you're successful?
That's a good question. Well, I mean, I don't know if I'm successful. You know what I mean? Like, I don't know if I'd call it that. But like, I think I've done a lot of things right. But I think it's easy to. Stock market is even easier than the real estate market. In knowing what you're supposed to do. I mean, everybody knows they should have bought Apple. When they came out, right? So like, what would you do different? I'd buy Apple. I'd forget real estate. You know what I mean? But like, you don't know that. You don't have the benefit of that. You don't have the benefit of that pre-knowledge, right? So I mean, what would I do differently? I probably would have just doubled down, and I would have bought some 100-unit apartment buildings, full leverage, and really gone after it. But I'm glad I did what I did. And I think it was the right move at the time. Even though the better move now would have been to go full leverage and get as many units under contract as possible. I don't know if that would have been the right move at the time, or even the smart move. It would have just worked out.
Yeah, you didn't know that then. That's the thing about real estate. We have, like you said, if and when the next bump comes, I wouldn't really call it a recession. My opinion is that last one was caused by financial institutions and the whole scheme of the subprime mortgages, where that's not going to happen again. They've regulated the hell out of that. But there's still market conditions change, but so something will happen. Prices will change. It's inevitable. We go in cycles. But you did what you did at the time, is what I'm hearing, and luckily you did double down on quite a bit. And I bet your friends, the sailing friends that you kept saying, hey, you should do this, they're looking now saying, dang, we should listen to you.
Yeah, one guy did say that to me the other day.
Oh yeah.
He says, you told us to do it and we ignored you. So I mean, it is what it is. I mean, it's fun when things work out because they worked out, but it could have easily just stayed down there. I don't know. So I think too, the other thing is you got to look at your time horizon. If you're a 20-something-year-old person, like, I think you're going to have a hard time not making money in real estate. People are, nobody's making more dirt, right? So, and the population's growing, so, you look at your time horizon, right? And if you're in your later part of your life, and, maybe your time horizon's shorter, I don't know. But I tell you what, I know that I want to be invested in real estate as much as possible. So.
Yeah. And what's also good right now, I've sold a lot of deals in the last couple of years to these young people with, we have down payment assistance. You can make a lot of money and still get down payment assistance. It's pretty amazing.
Oh, really? Yeah.
Oh yeah. You only need $1,000 to buy a house.
Wow.
It's pretty amazing. I think you can make up to 70 grand. I mean,
I do think there's going to be another recession. I mean, obviously there's going to be some sort of recession, but like, but I think what's going on right now is that people's incomes are I think rents are going up faster than people's incomes.
Yeah. And so, they're not they can't build it fast enough housing.
Yeah. So, I mean, what's going to happen there is, like, eventually, like, if your rent is $1,000 a month, or you could buy a house for $1,100 a month, you might be like, well, I'll just rent. But if that rent doubles and goes to $2,000 and you could buy a house for $1,200, you're going to be like, I can't afford to rent. I have to buy a house. You know what I mean? So home ownership's the lowest it's been since 1965. So I think that I don't see that. I see that as an interesting indicator in the fact that that's why I like condos or houses. Like, I like the smaller deals because it's like, let's say the mindset of the tenant or of the United States shifts from renter to owner. I've got product that I can sell these people, right? So I've got product to sell. So that's pretty helpful.
Here's why I love condos, and I think you're really in a great position because, I've studied the 40-year plan and way ahead. And the thing is, the largest growing sector of the population is the seniors, and they're downsizing into those condos. That's
Yeah.
really what's going on. Condos are more popular now, and they will be if you look ahead. So therefore, the price will go up. You're sitting perfect having all those condos. And again, they aren't building enough, and there's no more the closer in, there's no more land to build them on
Yeah.
like
Tell me,
before.
tell me, tell me about the 40-year plan. How did you
Oh,
handle?
I got a whole webinar on that.
Oh, I gotta
Or
listen to it.
a video I made. I'll have to dig it. It's on my YouTube channel. I have to dig it up and send it to you
Yeah,
because
I'd love to.
I studied all the trends, and it's pretty darn interesting if you start to look at cycles and start to put them together. That's what I help people figure out to do. So my personal suggestion as a realtor and a coach and a guru is, you want to get those, especially one level. I don't care if it's a condo or a townhouse or
Yeah.
a single family.
Yeah.
That's what the seniors need and want. And they're coming out of the burbs into closer in, or even staying in their burbs, but they got to have the one level. So
Interesting.
that is going to grow like crazy. Ramblers, yeah, they're good buys in
Cool.
all the first tier suburbs anywhere, because if you look at the population, it's pretty scary. That's the sector, that and the millennials. But they're your first time home buyers. We're probably serving as tenants, maybe those millennials, but the seniors they want to rent now, and they don't all want to go to the senior living. They can't afford it, some of them.
Yeah, no, I get it. Yeah,
They can afford the $1,500 rent, but not the $4,500 senior living.
yeah, no, interesting. Yeah.
Yeah.
Awesome. Awesome.
So great. So let's see. What do I got to do to wrap up? I got to look over. I just want to thank you, Brian. I got some good tips here, and I know you listeners, Brian taught us some things and secrets that we can all put to work in our investing business. So the one thing I want to tell you is, remember, I'm an active realtor, and I run a team of investment property realtors here in the Twin Cities, Minnesota. So if you want to book a strategy session with me, what you can do is go to my website, LeAnnRiley.com, and you'll see a bunch of buttons, and you can book a session and figure out maybe we got something we can help you with. I do have a lot of off-market rehab type things. And I just want to thank you for showing up and participating. We're going to have another speaker next month. His name is Andy Prashad, and he's a longtime investor, and he's also a real estate broker. So I love to kind of, we see a lot of deals, us realtor people. We just see, and I help people buy them all the time. I don't have enough money to buy all the
Yeah.
ones,
No, I know. Me neither.
So it's fun to see what's really out there. And so we really have our pulse on the market. And so join us for that. And then the other thing is, if you go to Facebook and look up LeAnn Riley's Real Estate Investing Club, you can join the club on Facebook. And there might be deals on there, or people talk about what they need and how do they find it. So thank you so much for coming. And Brian, thanks for taking the time to talk to us and help us out and teach us what we might need to do to grow our portfolios. Thanks a lot.
Yeah, you're welcome. And thanks for teaching me about the 40-year plan. I can't wait to read that.
Yeah,
Thank you.
We'll be talking again, Brian and I. We got other stuff going on. So thanks, everybody, and we'll catch you next time. Bye-bye.
Yeah.